Welcome to Iron Financial, where we forge stronger portfolios by stress testing company financials. We don't just look at the surface, we dig deep.
I'm your lead analyst, and today we're tearing down the Q4 2025 earnings report for the Boston Beer Company, ticker SAM.
And I'm your market skeptic. And let me tell you, this is a name that the market is completely confused on. It's a former darling that's been in a dogfight for years. And frankly, these new numbers are telling two completely different, and I mean wildly different stories.
That's exactly right. On one side, you have data that paints a picture of a company in a managed but very real decline. But then you look at another set of numbers and it looks like a masterclass in operational discipline and pure financial strength. So our job today is simple. Stress test both narratives and find out what's really going on.
Okay, let's dive right into this with this central contradiction, because you really can't get your head around the investment case for Boston Beer without understanding this fundamental conflict. This is the whole shebang right here. It's the core tension that's driving the stock, the entire bull versus bear debate in a single slide. And it's a stark one. I mean, think about it like this. On one hand, the company's physical presence in the market is getting smaller. They are selling less product, period. Less beer, less seltzer, their total revenue is going down. To put it simply, the kingdom is shrinking.
Whoa, hold on. Let's just pump the brakes right here because this slide says it all. You're telling me net revenue for the entire year is down 2.4%? Okay, that's the problem staring us right in the face. But in the very same breath, their gross margin is up 410 basis points. For anyone not living and breathing this stuff, a basis point is just 1/100%. So we are talking about a massive 4.1 percentage point jump in how much profit they make on every single sale. How on earth is that even possible? And that is the exact question. Is this a sign of a brilliantly managed, disciplined company that's ruthlessly cutting fat and focusing only on what makes money? You know, a sign of strength? Or are they just putting up some fancy wallpaper to cover some very serious, very deep structural cracks in the business? Right? Are they just squeezing the absolute last drops of juice out of a business that's fundamentally eroding underneath? That's the question we are here to answer. Is Boston Beer building a financial fortress, one that's designed to withstand any market siege? Or is this whole thing just a fancy facade, a pretty front on a building that's actually crumbling from the inside out? Let's dig in.
So let's start with the damage report. When you're stress testing any structure, you always inspect the visible cracks first. And the most glaring problem, the one every single bear on Wall Street will point to, is that top-line erosion. You just can't look away from the fact that people are buying less of their stuff. And the way we measure that, the real gut check metric, is something called depletions. Now, for anyone new here, depletions are just sales from the company's distributors to the retailers, you know, the bars, the grocery stores. It is the best proxy we have for what you, the consumer, are actually pulling off the shelves. And let me tell you, those numbers are flashing bright red. A 6% drop in the fourth quarter alone. Look, that's not a small wobble, that is a serious crack in the armor. We're talking about the end of the year, the critical holiday season, and consumers are walking away from your brands at a 6% year-over-year clip. That is an ugly, ugly headline number that absolutely spokes the market, and it should raise some serious questions about the health of their brands. And if we zoom out and look at the full year, it really doesn't get much better. The number smooths out a little bit, as you'd expect, but as you can see, you are still looking at a 4% overall decline for the entire 12-month period. And that proves this isn't some one-quarter fluke or a blip on the radar. No, this is a persistent trend. It shows a consistent, nagging weakness in consumer demand that's stretched across the entire fiscal year. That's not a weather problem, that's a portfolio problem. So that weakness in depletions translates directly, as you'd expect, to a 2.4% drop in full-year net revenue. They landed the year just under $2 billion at $1.965 billion. Look, that's still a substantial company, but the trajectory is undeniably pointing in the wrong direction. That revenue line is sagging, and it's sagging hard. And this isn't just a 2025 problem. Let's add some crucial context here because it's important to see the bigger picture. Boston Beer's revenue has actually declined by an average of 2% per year over the last 3 years. So what we're looking at here isn't a reaction to a bad quarter. This is a multi-year pattern of contraction. It's a structural issue, not just a flesh wound. Now, here's where it gets really interesting. And honestly, a little scary if you're a bull. It's where the weakness is coming from. If this damage was happening in some small experimental brand, you could write it off. Oh, they tried something, it didn't work. But that's not what's happening. The damage is coming from the very heart of the portfolio. Look at these names on the screen. These are not minor players. Twisted Tea has been their rock, a consistent growth engine for years. Truly Hard Seltzer. For a while, that brand was the entire company. It was the rocket ship. And Samuel Adams? That's the flagship, the brand that started it all. These are the load-bearing walls of the entire business. When your heavy lifters are struggling, that tells me the foundation itself is under stress. But this is where the entire narrative does a complete 180. This is where the bull case starts building its defense, and believe me, it is a powerful one. The argument shifts entirely from the size of the building to the integrity of its construction. The focus moves from how big the kingdom is to how well defended and profitable that kingdom is. So what you're saying is the bulls are just conceding that the company is shrinking? They're not just conceding it. They're arguing that it's almost irrelevant when you compare it to the massive, and I mean massive, gains they're making in profitability. While the top line is down, the company is systematically and successfully extracting way more profit from every single can and bottle it manages to sell. It's a total pivot from a growth story to an efficiency and profitability story. And management definitely wants you to know they're pleased with this pivot. The CFO, Diego Reynoso, he leads his statement by highlighting, quote, meaningful gross margin improvement and strong cash generation. These are the metrics they are laser focused on, and they're the ones they want investors to focus on too. Yeah, of course they do. But here's the skeptic's question. Is this real, sustainable operational strength, or are they just cutting costs to the bone, making the P&L statement look pretty, while the actual business withers away? Is this just clever financial engineering to put a mask on the decline? Well, the data on the slide is pretty undeniable, and it is the absolute cornerstone of the bull argument. A 410 basis point jump in full-year gross margin is just massive. Again, that's a 4.1 percentage point increase, from 44.4% all the way up to 48.5%. To put that into perspective, in the slow-moving world of consumer goods, an expansion of that size is almost unheard of in a single year. It's a huge operational win. Okay, fine. The number is impressive. I'll give you that. But how? How did they pull that off while sales were literally falling out from under them? You can't just wave a magic wand and make your margins expand that much. There has to be a blueprint. What did they actually do?
And this slide brilliantly lays out that this wasn't a fluke. It wasn't some one-time accounting trick. This was a multifaceted, deliberate operational overhaul. As you can see, they attacked the problem from every possible angle. Procurement savings, that's them negotiating better deals on their ingredients and packaging. Brewery efficiencies, that's fine-tuning their production lines to cut waste. Price increases, they found they could charge more and make it stick. And a favorable product mix, they intentionally pushed their most profitable products harder. It's a four-pronged attack on costs. Okay, I see the blueprint and it's solid. I have to admit, that's impressive execution. But let's not get carried away here. The source material is clear that these hard-won gains were partially offset by inflation and tariffs. So they fought this battle and won, but that war against rising costs, it isn't over. Those pressures aren't just going to disappear. And that incredible profitability pivot is what allows them to build the absolute core of the bull case, the balance sheet. This is the bedrock. This is the foundation on which the entire fortress is built. In a volatile market, with interest rates where they are, a company's financial foundation is everything. It's what separates the companies that can weather a storm from the ones that get washed away. Okay, so this is where Boston Beer is supposedly built like a bunker. Show me the proof. All right, I have to admit, that's a powerful number. You just can't argue with it. 0. Total. Debt. In today's corporate world where every other company is leveraged up to its eyeballs, that is an incredibly rare sight. It's a major, undeniable sign of financial strength and discipline. They owe nothing to nobody. They are their own masters. And they're not just debt-free. They are sitting on a huge pile of cash. They ended the year with over $223 million in cold, hard cash and equivalents. This is their war chest. This is their dry powder. It gives them immense flexibility to act on opportunities, to make an acquisition, to survive a downturn, all without ever having to ask a bank for permission. So here's the crucial point. Even with lower revenues, the core business is still a cash-generating machine. They cranked out over $270 million in cash just from their day-to-day operations in 2025. This isn't a company that's burning through its savings to stay alive. It's a company that is consistently and powerfully refilling its treasury. A fortress full of cash is great, but a fortress exists to protect something, right? A kingdom. If your kingdom is shrinking, if your sales are declining year after year, what's the long-term plan here? Are you just going to sit inside your thick walls and count your gold while the rest of the world and all your competitors move on without you? Management's answer to that very question is crystal clear, and it's a strategy completely focused on shareholder returns. They are taking that mountain of excess cash the business generates and handing it right back to the owners of the company, the shareholders. By aggressively buying back their own stock, they are screaming confidence in the long-term value of the business. They're telling you the best investment they can make is in themselves. And they put their money where their mouth is. They spent almost $200 million on buybacks in a single year. That's a huge return of capital. But let's look at this with a critical eye, okay? It is a great way to reward shareholders. I totally agree. But it can also be a very clever way to prop up your earnings per share number when your net income is weak. See, by reducing the number of shares out there, you can make your EPS look healthier than the underlying business really is. So is it a genuine sign of confidence, or is it just a little bit of financial maneuvering?
All right, now let's look to the future. This is the company's own forecast, their blueprint for 2026. This is where management lays out their official battle plan, and it tells us everything we need to know about their strategy going forward. And this is where we find out if they're actually planning to rebuild for growth and go on the attack, or if they're just digging in their heels and planning to manage this decline. Is this a plan for a counteroffensive, or are they just reinforcing the defenses of a shrinking perimeter? Let's take a look. Their guidance shows a clear, unambiguous continuation of the strategy we saw in 2025. They're basically shouting to the market, we are going to hold the line on margins at all costs. They expect to maintain or even slightly improve that profitability, targeting a massive 48 to 50% gross margin. They're telling you upfront to expect flat to slightly down volume again, with modest price hikes of 1 to 2%. What I see is a company officially guiding for another year of potential shrinkage. Let's be very clear. Flat to down mid-single digits is not a growth story. It's the opposite. And they're planning to spend an additional 20 to 40 million bucks on advertising just to try and achieve that. So they're spending more money just to stand still, or more likely, slide backwards again. That's not a compelling vision for the future. And what I see is a disciplined, realistic plan from a management team that actually understands the tough market they're in. They're focusing on what they can control, and that is profitability. They're refusing to chase unprofitable growth just to make the top-line number look pretty for a quarter. They're willing to sacrifice a little volume to maintain those incredible margins and that fortress balance sheet. That's not stagnation. That's just smart management.
And that's the billion-dollar question, isn't it? That is the entire debate we've been having, boiled down to one simple question. Two completely rational investors can look at that exact same 2026 guidance and come to two completely opposite, yet equally valid conclusions. Exactly. Has this company just accepted its fate as a smaller but highly profitable cash machine in a mature industry? Or are they just treading water, building up their financial strength before they launch a new wave of innovation to reignite that top-line growth? That's the question every single investor needs to answer for themselves.
All right, we've laid out the entire case from every angle. We have stress-tested that top line, and we have found the cracks. We've inspected the margins, and we have seen the steel reinforcements. We've kicked the tires on the balance sheet and found solid bedrock. So it's time to stop debating and start deciding. The facts are on the table. It is time for the iron financial verdict.
Okay, the bear case is simple, direct, and honestly pretty powerful. The house is shrinking. Revenue and volumes are in a clear, multi-year decline. Their core Peller brands are showing undeniable signs of stagnation. And their own forecast for 2026 promises more of the same, all while competition is getting more intense. It is a very compelling argument against the stock. But the bull case is entirely structural. It asks you to look past the short-term noise of volume trends and focus on the financial foundation. And that foundation is rock solid. We are talking about zero debt, massive gross margins that are still expanding, a business that absolutely gushes free cash flow, and a management team that's using that cash to aggressively buy back its own stock. It's a case built on pure financial strength and discipline.
After stress testing every single component, our verdict is in. Boston Beer is not a facade. The structural integrity is real. The profitability is real. That balance sheet is, without a doubt, a fortress. But, and this is a very, very big but, it is not a high-growth story right now. You simply cannot buy this stock expecting it to be a rocket ship. It's a well-built fortress in a really tough neighborhood. You own it because you expect it to withstand a siege, not because you expect it to go out and conquer new territory. It is, by definition, a defensive holding. Exactly. This is a high-quality defensive hold. This is for an investor who values proven profitability and balance sheet strength far more than they value speculative top-line growth. In a portfolio, this isn't your Vanguard, this is your Praetorian Guard. It is built to last, not necessarily to conquer.
So the crucial question for your portfolio comes down to this. What are you actually buying here? Are you paying for a fortress that will stand the test of time and eventually find a new way to grow from its incredibly strong financial base? Or are you buying into a fortress that is so well defended it's going to simply and slowly get surrounded by more innovative competitors and just become irrelevant over the next decade. That's our analysis. The numbers are clear, but the future isn't. You have the blueprint. Now you do the math. This is Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.